right, good afternoon, everyone. Thank you for joining us today for what I think is going to be a very robust conversation regarding the high-rise insurance market here in South Florida. Briefly, my name is David Ward. I'm a general manager with AKAM, and we're happy to have you for a discussion. We have some excellent experts here in the industry. First, I'd just like to introduce our first panelist, Sean Gabay. He is a vice president with Lockton Companies. Has a lot of experience, of course, in the insurance market as an insurance agent, and he'll be sharing his expertise that will be helpful for board of directors and general managers of the like. They have an office in Brickell in Miami, and they also have an office in Pembroke Pines, and we look forward to hearing from Sean today. Our other panelist guest is David Podein, who's a partner with Haber Law. Haber Law is a very successful, well-known law firm here in Miami. They do real estate law. They also do community association law, and their office is in Wynwood, which is a fairly new office here in Wynwood. So if you have a chance, definitely stop in and say hello to them. And we look forward to hearing from David's insight in terms of counsel and how to help board of directors in the legal side of insurance. So with that, why don't we start us off with Sean? Sean, if you'd like to get into just the general state of the property market. I think from general managers, and also board of directors, we've seen a lot of premium increases. And we're interested to hear what you've noticed and, what are the primary factors in what we're seeing.
Well, thank you, David, and thank you everybody for having me. Look forward to this discussion. So the insurance market for high-rise condos is in a generationally hard market. We've never seen anything like this before, and there are multiple factors, some weighing a little bit more than others. But on this wheel, you'll see some of the factors. On the top, cat losses. Cat stands for catastrophic. So those weather events that create billion-dollar plus losses, which we'll see on the next slide, some of those. But it's not only what happens here in Florida or United States, it's globally. We are globally connected through the last factor, which we'll talk about, reinsurance. So the earthquakes in Turkey that cause $1 billion of losses, that does affect us in the marketplace here in South Florida. Litigation is also one of the factors. Litigation in Florida got to a point where the state stepped in and held a special session in December and signed into law. And then last week on Friday, they enhanced that a little bit more. But carriers were taking a look at their books and their losses, and they were paying out more in litigation than actual claims. So carriers said, it just doesn't make good business sense to insure in Florida. So we had a lot of carriers that left the market, and carriers leaving the market creates less of a supply, right? Less capacity that is available in the market. So it's, simple supply and demand issue. If the supply of capacity goes down and the demand isn't going anywhere, if anything, it continues to increase as we build more buildings. That's a supply and demand imbalance. But another factor that's interesting is the carriers that are left insuring in Florida, they have actually decreased the amount of capacity that they offer. So, for example, if carrier A in a given year offered $500 million of coverage, right, to multiple buildings across the state, they're now shrinking that capacity to 400 million or 300 million. So we have less carriers and now less capacity for the carriers that are left. So what that led to is carriers saying we can't offer full limits, or we can't offer a $20 million line slip, right? So they're reducing the amount of coverage for any given building. Another factor is inflation, right? We've seen record inflation in the past year and a half, and carriers are paying out claims based off of today's prices, right? The cost of building material, cost of labor. So carriers are taking that into consideration, right? Because they're paying claims based off of today's values. And when we talk about values, keep going along the wheel. When we talk about values, carriers are really digging their heels with valuations, also appraisals, right? Florida statute says we need an appraisal every 3 years. And carriers are now rejecting appraisals that are even a year old if they feel the valuations are too low. So it's very important to look at those valuations. And then the last one on the wheel is reinsurance. And I saved it for last on purpose. Again, reinsurance is the insurance that these carriers purchase. So that carrier A that is now only offering $300 million of capacity, they retain the first, let's say 100 million, but they buy reinsurance for the next 200 million, right? That's just an example. Reinsurance has been going up the past 4 years, but the major date for reinsurance is January 1st, 1/1, which just passed. And the reinsurance renewals for this, for 2023, January 1st, were just horrendous. There were carriers that the reinsurance increased anywhere from 70 to 200%. And carriers are not going to absorb that additional cost. They're going to pass it down. So reinsurance, as you'll see in a couple slides, is going to be the main driver of why the insurance is increasing in South Florida for 2023. So if we can go to the next slide, we'll talk about cat losses. Those weather events over $1 billion. This is last year alone. We had 18 separate billion-dollar weather events. It wasn't just Hurricane Ian. There were 18 separate. The year before was actually a little bit more in the low 20s, 20 weather events. If we keep going to the next slide. So we talked about reinsurance, right? So this is the 2023 outlook, and we're not going to read, all the articles, but these 3 articles came out just around January 1st, either just before or just after. And on the bottom right, just like we have an issue with capacity, reinsurance has an issue with capacity as well. And it was estimated about a $60 billion shortfall of capacity for reinsurance. And then you'll see in some of the articles here, reinsurance rates went up as much as 200%. And again, this is going to be the sole driver of what's affecting the insurance rates for high rises. Go to the next slide.
Sean, if I could jump in a quick question so that people understand like how much of an impact the reinsurance rate are. I might have heard that approximately 40 to 60% of the premium that a condo association might pay is kind of directly correlated to or attributed to reinsurance for the carrier on property. Is that a good estimate, or what's your insight for that?
So in years past, I would say that's accurate. However, this past reinsurance renewal on January 1st, the reinsurance rates went up substantially. In some cases double or triple, and increases of that magnitude is going to have more of an effect on the reinsurance. So I would venture to say it's more than 40% for this year. Yes. So moving on, how do we navigate this market, right? What are some of the landmines that we should be aware of and try to avoid? So if you see here, you have 4 verticals: property, general liability, umbrella, and flood. Property for South Florida high-rise condos is the single largest premium policy. We talked about some of the variables on that wheel. The appraisals, carriers are rejecting appraisals, even if they're a year and a half old, if the valuation is too low. In years past, they would quote, they would accept it. Last year, they would quote and just make some internal changes. This year, they're just simply not quoting. So it's very important to reevaluate your appraisal, because remember, we have a smaller pool of carriers. And if those carriers are not quoting because of the appraisal, it's going to be very hard to secure full limits to comply with statute and lender requirements. And that leads to the accepted valuations, right, which we just talked about. Deductibles. In years past, we secured 1% deductibles, 2%, 3%. Those days have long passed us. The lowest deductible is 3%, 5% is more of the standard, but now we're seeing carriers increase to 7.5% and even 10% deductibles. So, depending on financial situation of each individual association, you have to evaluate that. What is the risk to reward as far as premium versus exposure? But deductibles are becoming an issue. The carriers on the property side that are left, we have QBE, which is one of the carriers that can offer full limits. QBE has been renewing the majority of their book, but they're not writing any more new business. Associations are probably seeing the lowest increases out of all carriers with QBE. Outside of QBE, you have what's called a shared and layered, where you stack carriers on top of each other, right? And the carriers that you saw for 10 million, now it's 5 million or even 2.5. So those layered programs where it used to be 4 carriers, 5 carriers turned into 10. And that's where you see the premiums exponentially get higher.
Sean, on those layered programs, does that take much longer to underwrite and bid out and work with your clients when they're in that renewal process? Could you speak to sort of the timing issues?
Yeah, that's a good point, David. So there is a big difference in timing, right? So as insurance brokers, we can submit 120 days before renewal. And carriers don't really start working on it, unfortunately, on the 120-day mark, even though we're on day one. They really start looking at these renewals, modeling and all that about 45 days in advance. But it's not until within 30 days, even 20 days, and some carriers within 2 weeks, where we start getting initial quotes. And with the shared and layered program, we don't just get the first quote and then start stacking on top of each other. It's an art where you pull a carrier from here and substitute it, and you literally build a Jenga tower, and then you break it down, and then you build it up again, and you keep modifying it to get the best possible structure. So the timing on that, unfortunately, it started last year, and I anticipated we're seeing it this year, but as we get closer to the May 31st renewal date, which half of South Florida renews then, we'll see the layered programs come in, the final ones, probably the day before, as opposed to QBE. Yesterday I received my renewal for a 531. It's night and day. So the timing, there's a big difference in timing. The last one I think is interesting to point out is Citizens, right? Citizens is a state-run insurance carrier. And I remember when I started my career, Citizens was the go-to. That's where everybody went to. But as the market started to decline and the private marketplace was more competitive, right, people moved away from Citizens. Well, now that's changing as the market has increased so rapidly. And there is a big shift and a big, basically a big migration to Citizens. And there's a lot that goes into Citizens. Especially 2 weeks ago, they just put out a new bulletin where they have even more requirements specifically for older properties that are past due on their recertification. So those Citizens options, need to start working on them about 6 to 8 months before the renewal. We're starting on them about a month in advance. You already missed the boat. So just be careful with the Citizens option. In regards to general liability, carriers are adding more and more exclusions. Be careful with the exclusions, water damage exclusions, construction exclusions. There are only 2 carriers out there, 2 programs that have clean forms without exclusions. So that's something to be aware of. And deductibles, right? Carriers are looking to change it from a per occurrence deductible to a per claim. And it's a big difference, right? If you have a water event and there's 10 units involved and the association was negligent, per occurrence, you really only have one deductible. But if you have a per claim, you're looking at potentially 10 different, 10 separate deductibles. And, the benchmark rate continues to increase. On our pre-call, we talked about the next topic, which is umbrella. Umbrella market in the condo world is completely, it looks completely different than it did 5 years ago. 5 years ago, we had, 5 or 6 condo specific programs. Now we're down to 2, 2.5. And the difference between condo versus non-condo umbrella, it's staggering. Not only the limits are different, the premium's different, and the coverages are different. Condo umbrella, you can get 25 million limit. Non-condo, 5. Premium for condo is about 10,000. Non-condo, it could be as high as 150, 200,000. And
are you seeing your clients reduce the amount of coverage because of the big price increases? Obviously, within the framework of the Condo Act, Chapter 718, that there are limitations on how much insurance they need. But have you seen a trend, Sean, where in the past maybe buildings were overinsured or very robustly insured, and now they're saying, Sean, what's the bare minimum we can do?
Yeah, we get that question a lot, and there's really 3 hurdles, right? David, you mentioned one. One is the Florida statute. Second is the individual condo docs, kind of mirror what the statute says. But the third one is really where we can potentially see and have seen repercussions, and that's lenders, right? Mortgage, each unit owner has mortgage, and personally, in Lockton's condo book, we don't have any buildings that don't insure to full limits. We've been able to secure full limits for our associations, but I have seen, and I've spoken to associations that don't carry full limits, and they haven't been able to close on any units. Some of their unit owners were forced place coverage, meaning their lender actually bought insurance for them, which was significantly more expensive. And just, again, closings are at a standstill unless it's an all cash deal. So that's where we've seen the most pain with associations not purchasing full property limits. David, I'm interested. Have you heard of any associations that aren't purchasing full limits, that there are repercussions, from the state?
I haven't had any go down that path, but I'm just seeing these insurance issues bubble up, particularly with budget season. And we just sort of got out of the some of the condos tie their budget season to the annual calendar. So we just got through this wave at the end of Q4 2022 of just huge increases in the regular assessments because of the insurance costs. So I see it as a tough situation, because as the economy continues to get a little worse and these insurance prices keep going up, it's a tough situation for them.
Yeah. Last year was a tough year in 2022, of all those factors that we mentioned on the previous slide. 2023 could be worse because of reinsurance. Again, the carriers are not going to absorb the cost. They're going to pass those massive increases down. But I neglected to mention on the property, right? On this property vertical that we see right now, the layered markets, right? And there's a difference from newer buildings versus older high-rise buildings, right? Impact versus non-impact. But we're seeing right now the layered markets substantially increase, where QBE is going up about 30 to 40%, now 35 to 40%. But Citizens Citizens seems to be, from what we're seeing and the quotes that we're getting, about half of the layered market rate. And that's why I thought it was important to bring it up, because again, there's a big shift to Citizens, and there's pros and cons, which is another webinar, right? But definitely an option that should be explored. Going back to the umbrella, just one thing, we talked about limits, we talked about premium, but the biggest deficiency, if you will, with these non-condo umbrellas is the non-condo umbrellas do not sit excess over the D&O. The condo umbrella programs do. They'll sit over the D&O and the general liability, but the non-condo ones will not sit excess over the D&O. So it's something that, there's ways to get around it, but that is something that definitely everybody should be aware of. And then not too much on flood. FEMA rolled out a new rating system, risk rating 2.0. So that is, it actually has benefited a lot of associations with decrease in premiums.
Sean, just really quick, I think the umbrella point is really fascinating now, because your point is that the market for umbrella, I've seen it for association renewals personally, representing board of directors. What used to be just a simple renewal, almost the same terms, same coverage, perhaps a 2 or 3% increase is now like drastically different, 100% increase for even more premium with less coverage. So just because it's drastically different, especially for those high rises that might have mixed use, that's the new trend here, as David Podein could probably touch on, and the condominiums he's seeing that are new construction. The trend is that first level, right, second level for high rises are often restaurants or stores or these sorts of things. How does that come into play? And for the beginner on the call, maybe that's still learning about insurance for condos, how does umbrella come into play as well after maybe general liability and D&O?
Sure. So the umbrella policy is a very important policy, because that policy affords additional limits, call it 25 million, excess over third-party policies. So what's a third-party policy? That's a policy that the general public is going to sue the association. So general liability is a third-party coverage policy. Directors and officers liability is also a third-party policy. So the general liability policy has $1 million per occurrence limit. The D&O has $1 million per occurrence limit. Any claims in excess of $1 million, that's when we see the umbrella policy kick in, because it sits on top, or it sits excess of that $1 million, that first million. And again, the condo umbrella programs would sit over both the general liability and D&O. The non-condo programs or non-condo policies will sit excess just over the general liability. So remember, D&O, we're affording coverage for past, present, and future board members, committee members, volunteers, and management. Right. So it's very important, and it doesn't just cover the board. Now, as far as mixed use, I'll tell you this: the main variables that kick a condominium out of a condo umbrella program, it's more so if a building is past due on their recertification, 40, 50, 60 year, that association is not going to be able to secure a condo program, right? If it's the height of the building also can play a factor, and the carriers have different views on how many stories. If an older building does have their recertification, but it's not fully sprinklered, well, one of them has an issue versus the other. So it depends on the profile of the building, right? But I would say that the overwhelming majority, the reason why a condo and an association will not qualify for one is that recertification. All right. So as far as this slide goes, it's a consideration to protect the association further. So basically what this is, and I happen to be a former board member, and I went through an experience that kind of changed my view of insurance, and just not just the policies that we purchase, property liability and all that. So the backstory is, we hired a contractor, they did all the work all failed, and then we hired an attorney. And at the first mediation, found out the contractor has no insurance. And every association, especially after the collapse and the recertifications, is doing some sort of project. And the industry standard is to collect this certificate of insurance, right? And list the association as additional insured and waiver of subrogation and all that good stuff. We did all that. And we still found out that the contractor has no insurance. And it wasn't a falsified certificate. But this is the industry standard, and it's a flawed system because policies are, 100, 200 pages thick. Just like the associations, contractors are that 100 pages or plus. The majority of what's in there in the policies are exclusions, what's not covered. And you won't find any exclusions on this one-page certificate. Certificate only tells you what carrier, when it renews, the limits, and some other basic stuff. So that happened to our association. I wasn't an owner when they hired, but they asked me to join the board to fix a problem, but it wasn't fixable because the contractor had an exclusion that just basically restricted any and all coverage. I'll tell you the most common exclusion for contractors in South Florida is a residential exclusion, which says any work done in a residential building is not covered, or a condominium exclusion. There's many varieties, many variations of that exclusion. So basically, one thing I urge is not to rely on anybody or this certificate for that matter, right? You have to really take a deep dive into it, and we created a program that takes this to the next level, and also ducktails this into the actual contract, right? We're not looking to replace David and his team, right? And your general counsel. We're looking to be an extension and to be a resource, and to really make sure that the insurance wording in the contract has what is required to trigger certain coverages within this certificate, right? If you see on the right hand or the left hand side, as required per written contract, if you don't have something like that in your contract, that additional insured status is null and void, right? Because it has to be per written contract. So just something that I lived through, led to a special assessment, and as a volunteer, it was a tough meeting, right? Especially something that could have been avoided. So David, I think you're up.
Sure, thank you for that. In terms of from a legal perspective, we could schedule a series of probably 5 or 6 webinars on all the ways insurance comes up from association operations, dealing with unit owners, dealing with contractors and vendors, as Sean said, as well as management companies, insurance, and their indemnification that they seek from the association's policies. And insurance zigzags across the condominium in many ways. But I think one big part I wanted to touch on, and it came up in numerous ways with Sean's, is on the renewal process. I think now that the stakes are so high in terms of the difficulty in obtaining insurance and the cost and the time crunch and the pressure, that the renewal process is very important. And what I mean by that is the timing in your approach to the renewal process. That it's very important for the association, through their board, working with not only the property management company like AKAM, but also with their insurance professionals, to take a step back and have a macro look at where are we in the calendar of the building? When is our budget coming up? When is our insurance renewal coming up? And then layer on top of that, what are the external factors? What are the extra factors we have going on? Do we have a huge roof project going on right now that's not going to be finished by the time we're going through the renewal process, the crunch time that Sean described? Where are we with our recertification with the county or the city? And how does that factor in? So I've been advising clients to take a step back and come up with sort of your budget and insurance renewal calendar. So you're not caught off by surprise of, oh, well, we didn't realize that, not having this project complete, nothing's going wrong with the project. The contractor's doing a good job. We're within budget, we're on time, but how does that play in with your renewal process? So first key takeaway is to really take a macro look, work with your professionals, rely on your consultants and professionals, and come up with a plan taking these factors in.
No, definitely, David. Thank you. I wanted to add to that calendar you were speaking about. I totally agree. And the one thing that I think Sean touched on, but just to kind of tie both your comments together, is on that calendar and the budgeting, the tricky ones are ones that are not every year. So when you do have an appraisal that's by statute required, every 3 years, that's somehow you want to make sure you make a note with your management team and with your board that it's not an annual item, but for budgeting, you don't want to be caught off guard that you might have, a 25%, 30% increase on rate as far as the market premium. But then also if your building is up 15 or 20% on the appraisal, that you have to essentially combine those, that you have a higher rate potentially on a more valuable building. So that's one of those, almost like an inspection that might happen one every 5 years, or, on other items like fire or elevator, that's one that could catch a board or a budget off guard once every 3 years.
Yeah, and David, I would add to that, it's in this market with and how the underwriters are really digging their heels when it comes to appraisals. It's not just, okay, we did an appraisal 2 years, we don't have to think about it till, the next renewal or 2 renewals from now. Because, if even a 2-year-old appraisal, if the replacement cost per square foot, let's just say is $110 a square foot, right? You can be faced with the situation where the underwriter is saying, we're just not quoting this. So I think that, yes, look at that 3-year window to comply with Florida statute, but I think that you have to still analyze, often where your current appraisal lands, what the replacement cost per square foot, and each appraiser does it differently, right? Because, some appraisers lump the tower and a garage together. Well, if you separate that, you'll find, you'll get the true replacement cost per square foot for the actual superstructure of the building, because the replacement cost for a garage is much lower than the actual tower. So, it's important to look at it, now, right? Because you're absolutely right. If you don't take that into consideration, and then 30 days, 45 days, or even less before renewal, the underwriter say, I'm sorry, you need a new appraisal, and then you're scrambling to get an appraisal, and you didn't take into consideration when you were putting together your budget, that's when it can really throw things off. And a 1-year-old appraisal, if all else being equal, an appraisal that was done a year ago, if you get a new one today, it's probably going to go up about 20%. Because the appraisal system had 3 to 4 updates in the past year, and each one of them has gone up substantially because of the cost of building material and the cost of labor. So we're seeing that more and more often. I don't want any association thinking they're safe just because their appraisal is a 1.5 years old.
Yeah, it's a great point, and I've even seen some. Not with clients I'm working directly with, but with unit owners that I've talked to at other buildings. I've even seen some high-end buildings where they're behind on their appraisal schedule, and they've renewed based on older appraisals. I don't know how they were able to do that, but they did renew on older appraisals. And the unit owners are angry because they're saying, look how old this appraisal is. We don't feel that we're adequately insured. And with how much, like you said, building materials and costs have gone up, and then how much property values have gone up, even with the economy having some headwinds, we still have had massive price increases in property valuations over the last couple of years that on, a 2, 3, 4, 500 plus $1 million high-rise condo, a 20-30% gap, that's a big deal.
Yeah. Yeah, those can be very, very large increases. Yeah.
David, Podein, maybe we can just perfectly transition to the next topic I think you wanted to cover in terms of the deductibles or maybe special assessment process. The one thing I would advise boards also and management teams that be careful with the basically the appraisal amount and how that affects your building. Of course, you always want your premium to be low, right? And you want your appraisal to be low for your budgeting. That's obvious. You want to pay as little as you can to get through your budget, to not impact the increase of, operating increases for budget in January 1st, if that's your budget. But of course, when you actually do have, God forbid, a Cat 5 hurricane and a full destruction on your building, that's when you want your appraisal to be as high as possible, so that you have the most amount on your claim to physically reconstruct your building. So that's you don't want to have to use insurance until you need it, right? So just be careful with that appraisal value. You want a fair appraisal company to come in once every 3 years and ensure, yes, it might make your premium higher, but in terms of fiscal responsibility and your responsibility as a board, you want to be able to protect your building so that if there is that 3% deductible or 5% deductible, you're fully covered to rebuild a $50, $75 million building.
Yeah, it's a great point. And deductibles is a big issue. As Sean touched on, deductibles are getting very expensive because as the percentage increases, this turns into a big number. So similar to the renewal process, with deductibles, it's important to take a step back and you need to have a financial plan in terms of under a worst case scenario where there is going to be hurricane damage and you need to make one of these large deductibles. How are you going to pay for that? Are you just sort of extending and pretending and saying, well, we will special assess if and when that comes? That's not necessarily the best plan, because sometimes associations, they have a problem with, well, we need to pay we don't have enough, we're nowhere close with funds to pay the deductible, but are we going to special assess just for the deductible, then wait and see, and then special assess again to cover work that's not covered by the insurance in connection with the loss? So I've had clients that they have standby letters of credit that they can draw against to pay deductibles, particularly these large hurricane ones. Another thing that's important, it's a small item, but it's an important takeaway, particularly I know we have a bunch of board members and property managers, is the board, it is within the board's power to adjust deductibles with what they're able to get within the market. Florida statute governs that and basically says they need to do what is comparable in the industry. But it's important to remember that when you change those deductibles as part of that renewal process, that's a 14-day notice meeting. That's not a regular board meeting. All the time I see it tacked on, a regular board meeting, 2-day notice. Okay, let's add on agenda item 7, approval. We're going to approve of the insurance renewal and we're changing the deductibles and all that. So that's actually a 14-day notice. It's still a board decision, but that's an important point.
That's a great point, David. How about, kind of going into maybe the next topics? Are there any pitfalls that you're seeing from the legal side where you're giving counsel, to your boards directly or to your general managers? Where are you seeing vulnerabilities for management teams or board of directors related to general liability or directors and officers?
That's a great question. And again, another one that could be its own presentation. But I think for purposes of today, I think the D&O is very important. In the post Surfside climate with the heightened scrutiny on board members, with the heightened agitation in condominiums, you have people saying, I don't want to get sued. Why do I want to serve on this board? I don't want to get sued. And so within that vein, I think people overly rely on, oh, well, we have D&O coverage. I think it's really important for directors to work with their insurance professionals, work with their counsel at the outset of coming onto the board, sort of as part of that education process, you get your certification. But I would urge them to dive deeper and understand, what are the exclusions in this D&O policy? How do I get outside of my coverage? What bad acts, what intentional acts are not covered? You know, particularly in this day and age where with email and people getting into personal disputes, I mean, there's pages and pages and pages of exclusions and loopholes, and not, Sean could probably maybe speak to some that come up here and there, but overall, it's really important to understand, yes, you have D&O insurance, but what does that cover and what does that not cover?
Yeah, and I'll give one example, right? Because there are some associations that are electing not to purchase full property limits, right? And, you know, they're in the back of their minds, they're saying, well, you know, if God forbid something happened, we bought only a 10 million limit and there was a $15-20 million claim. Well, we have D&O, right? Because it was a decision of the board. But as David mentioned, there are exclusions, and a standard exclusion under a D&O policy is a property damage exclusion, right? And it's, you know, there's wording arising out of, you know, so on and so forth, but there's a property damage exclusion. So if there was a hurricane that caused $15 million of damage and there's a $5 million shortfall because the association only paid or only purchased 10 million limit, that $5 million, that delta cannot be claimed under the D&O, right? Because it stemmed from a property damage claim. You know, that's one of the you know, standard exclusions. But you know, again, we can do a webinar just on the D&O exclusions. But yes, there are pages and pages of exclusions under the D&O policy.
Okay, excellent. Some great input from you both. We do have a couple of questions from the audience while we're kind of going through. We're closer to the wrapping up, you know, kind of our session here in the discussion insurance. We have a simple, you know, but very good question from a participant. What is the definition of a high rise when we talk about high rise condominiums? High rise, I think it's not an exact definition, but typically any kind of condominium that is anywhere from 10 to 12 floors or above. Often when we think of real true high rises, it could be a 40 floor building, 55 floors, some I've seen, and then they have new design buildings going up in downtown Miami, I think, that will break records up to 100 floors. So that's what I think a high rise. You might hear the term mid rise, anywhere from like 3 to 10 floors, 3 to 12. But high rises typically have, you know, 20, 30, or 40, 50 floors, and that's what we mean. We have another question from a participant, who I think is an excellent question. So it's actually, I think, for both panelists. So feel free to, who wants to go first. How can an association or a board give 14-day notice for a meeting if they intend to, say, change the hurricane deductible when they don't get the actual final quote from the carrier or one of the carriers or agent team only a few days prior before the renewal? So I thought that was a great question.
I've seen associations cure it by doing a ratification. So it was approved on a 2-day regular board meeting. The next 14-day notice one saying, we're ratifying this. Here's the 14-day notice. It's a simple answer to it.
Yeah, and from my perspective, you know, when we're securing insurance renewals, right, and specifically with a shared and layered program where you're stacking carriers on top of each other, the most critical layer is that first layer, the carrier that's going to provide that first dollar coverage. That is the carrier that is basically going to dictate or kind of create the foundation and who sets that hurricane or named storm deductible. That doesn't come into play. I mean, we secure the primary layer weeks. I would say at least a few weeks before. So it's important to stay in communication with your insurance broker, right? Especially when you have shared and layered programs, when you're building it, taking it down. At least the process that I have is to start having those conversations and show the initial quotes, if possible 30 days out, and then have weekly meetings and show the different changes. But you'll have that primary layer, which is going to stipulate what that hurricane deductible is. So if you get prior notice of it, right, and you have that open communication with your broker, you'll know if the deductible is changing, and then you can, potentially, give that 14-day notice as opposed to ratifying. But if you can't, then as David said, you can vote on it and then ratify.
Okay, thank you both. That's some great information. Question for probably Sean: if a board or a manager was, strongly considering, changing agents, perhaps there is maybe skeptical about pricing, or if a thorough, vetting or bid process was done, how would you recommend going through that process?
I would say start early. And early is not 2 months or 3 months. Early is 6 or 7 months before the renewal. And the ideal way, right, that would yield probably the best results for the association is to hold broker interviews, and to talk about the current program, talk about, the state of the market, resources, strategies, right? And for the board to collectively, meet and ask questions of each broker, and then make a decision on what broker they feel they would partner the best with, who would lead them in the direction or shepherd the process, the most efficiently with the best results. Because I would say that whatever broker the association decides to go with should be elected before the 4-month mark. And for older buildings, I would say even before that, because there's a lot of pre-work that goes into it, right? We have conversations with the engineers and roofers and so on and so forth. So if associations can make that decision well ahead of time, but too many times I see the mistake of associations saying, we can bring in 2-3 brokers and we can bid it out, right? And get multiple quotes. Well, remember, in Florida, that's very hard to do because you only have a small handful of carriers that can write a high-rise condo that's $150, $200, $300 million in value. We don't have a lot of carriers that can take all that capacity in one shot. So if you don't have one of those carriers like QBE, or Citizens can do it, but that's a different topic. But you have this what's called the shared and layered, and you stack carriers on top of each other. And let's just say, for example, if you have 20 carriers, right, and you give 10 carriers to one broker and 10 carriers to another, but the ideal structure is carrier 1, 3, 7, 13, 15, and 18. If you split the markets, you're never going to see that combination because that combination is going to be separated from broker A and broker B. So you'll never see that ideal structure, the most competitive structure. So when it comes to the shared and layered, I always recommend to keep those together, right? And but that's why it's ideal to have one broker, but to make the decision well ahead of time.
Okay, great. We have another question. Let's see here. They're asking about what impact does a well-maintained building have with 40% EIFS with masonry have on getting coverage? That's above my pay grade, so you could educate us on that particular technicality, please.
Yeah, that's EFIS. So every association, every building has a different risk profile. So well-maintained building can mean a lot of different things. So, uh, there are carriers that won't touch EFIS, right? Even if it is 40%. So it depends on the other variables of the building and the risk profile. And in this market, because we have a limited amount of carriers and limited capacity, these carriers are just they're inundated with submissions and they have so many options, so many buildings. So they are literally picking which ones they want. They're not really giving any favors, right, with pricing, because they're saying, well, we have this much amount of capacity. If we don't use it here, they'll pay for it, and they probably need it a lot more, right? And they'll pay double. So the key with a building like that, or any building that um, isn't a 2-year-old building that is that carriers are salivating over, it's to highlight everything that you said, maintain, well maintained. If the building has a leak detection system, and then not only saying that it's a leak detection system, but the inner workings of it, if it goes to an app, and if there's an automatic shut-off valve. But it's really to highlight the positives of the building, and what makes the building stand out, right? And those are the ways to overcome, maybe a 40% EFIS. And again, some carriers, it's just a hard no, but it's really diving into what makes that building stand out.
Definitely. No, and related to that, just in terms of renewals, even on a simple renewal where your carrier might, if you're lucky to have QBE renews, they're going to send out somebody that represents that carrier to do an inspection even after renewal. And often what in years past used to be what I would see as a manager, just checking on the roof was their primary concern. With what David Podein was mentioning, it's just heightened scrutiny in general sense, CERT side. So they're really now, inspecting the entire property. So if you do have amenities, if you do have a pool deck, if you do have a garage that might have a pool above a garage level or things of that nature, even after renewal, they're walking your property and they're giving you, they should be giving you advance notice on what might be a cause for their concern, 11, 12 months away. So something to keep in mind. Question I have for David Podein: if an association is initially denied a claim that they really do feel that it's legitimate and that should have been, attended to or, processed and paid out by their insurance carrier, what should they do? What's their best process in response to a denial?
Hire an attorney. In all seriousness, though, it is a legal process, and their best path is at the outset. It's to make sure that everyone touching an insurance claim is trained on how to respond, how to document, who to report to, who to follow up with, documentation of before, during, and after something happens. So properly addressing the claim, really starts with at the outset. And then in terms of a claim being denied, there's a multitude of factors and bad faith litigation, claims coverage, and all that. So, there is a process. It's not just like you get a letter and you're done and you have to pack your stuff up. But I would say consult your legal professional to get into the details of that.
Very good. Very good. General question quickly as we're wrapping up for Sean. If someone's listening and just trying to learn about insurance and they're not necessarily a high-rise condominium, they might be 3, 4, 5 stories, which is a common height in Florida, especially in certain areas of, I think, Broward as well. How much of the presentation and what we're talking about is relevant in terms of, carriers in the market and what kind of risks they're willing to take on the lower, height buildings?
Yeah. So this is relevant to all South Florida condominiums, right? And the reason is because a mid-rise or a low-rise is still buying property insurance, and that carrier is still purchasing reinsurance that costs that carrier double. So those costs are going to be passed through, and there are no properties that are shielded from what's going on in the market, and more so than that, these carriers are now increasing what they call their minimum premium, right? The minimum amount that the carriers are willing to offer coverage by charging. So if you have a 3-4 story property and 10 units, right, you might be hit from two sides. One is the reinsurance cost, but then the second one is the minimum premiums. So if your expiring premium was 20,000 because that was maybe what that carrier's minimum premium is, but now this year it's 50,000, right? That can have an effect. So again, high rise, low rise, mid rise, is not no association is shielded from what's going on in today's Florida insurance market.
Excellent. Thank you, Sean. One quick question. We're coming up almost at the end of 1 hour. Thank you, everyone, for staying with us. Great discussion. This is, I think, a good question from one of the participants. If you know that your agent is reaching out to all like a similar, perhaps limited carrier market that's willing to take this coastal, especially risk in South Florida, is there really much difference that a different agent might get in terms of premiums when they're reaching out to a similar pool? Do they have, different relationships where different amounts can come into play, or as long as your agent's reaching out to the same pool, are you pretty much going to be getting the same quotes as any other agent? That's
actually a very interesting question. So the answer is yes and no, right? So in general, if brokers, right, like myself, go out to the market, and for the overwhelming majority of carriers, we use what's called a wholesale broker. If there are wholesale brokers, right, or if the brokers like myself used the same wholesale brokers, yes, you'll net the same result. I would say that there's probably 2 or 3 premier wholesale brokers that truly understand the condominium market. But so it really depends on what wholesale broker they're using, A. But then the other factor, which could make a difference, is, and it's not traditional in this marketplace, but we're not in a traditional market, right? But my team and Lockton, we've been using our reinsurance team called Lockton Re, and reinsurance is typically for the carriers to buy insurance, but we've actually been getting quotes from our Lockton Re team and substituting the layers with true reinsurance, and those rates have been significantly lower. Now, reinsurance likes to play on the higher limits. So for a building that's $10 million in value, 20 million, it's not going to work. It's more for the 75, 100, 200 million dollar buildings, but that can make a difference. And again, it's not traditional. So but if there's another broker that is using reinsurance, then yeah, all things should be equal if they're doing that and they're using the premier wholesale brokers.
Okay, excellent. David Podein, any final thoughts as we wrap up? We can definitely share contact information for everybody. I want to thank David Podein, Sean Gabay for great input. I think that's going to be really helpful, really useful for board of directors, general managers, or CAMs on the call. If you're interested at all in learning more about how Lockton or Sean Gabay can help you and what you need to do in terms of protecting your association and being properly insured, we have Sean's email address here. Also, David Podein, who's a partner at Haber Law. If you're also interested in anything legal or potentially working with Haber Law in terms of counsel for your association, we do have email addresses here. And then also myself as a general manager, with AKAM, please email me anytime. I'm happy to help. 10 years in, I can't believe this. I realized this 10-year anniversary, I passed my CAM license July 2013. So time flies, but there's always something to learn. We're here to help in terms of management company. We're here to serve our clients. That's what we all share, the three of us on the call today. We're here to serve our clients and help them navigate really difficult situations, especially in these times for insurance. So if there's anything else, thank you so much for joining us. Thank you so much for participating. And we look forward to working with you in the future.
Yeah, thank you so much. Thanks for having us. I also want to thank everyone that worked so hard behind the scenes to make this happen. Beautiful presentation, setting everything up. We really appreciate that. So please reach out. Email is the best way to get a hold of me. We can help you with everything from the dog letter to the $50 million special assessment, contracts, and litigation coming out of that. So thank you so much. Again, AKAM for hosting and Sean for all your insights.
Yep, I echo what David and David said, and I appreciate everybody joining us. Thank you for your time.
Thank you, everyone. Thank you both.